recently released a report on Asian currencies, and to discuss that we have with us Ian Stannard of Morgan Stanley on the phone line all the way from London. Ian, thanks so much for joining us. You know, it spooked a lot of markets the way the PBOC has just gone ahead and devalued the currency 2 days in a row. I understand that there is some pressure in Chinese government circles to devalue the currency by up to almost 10%, and that would create havoc, especially in a lot of markets like India. What's your own sense on how the currency will move from here on, both the Indian rupee as well as the yuan?
Yes, no, certainly the move by China has had a larger impact within the region and globally amongst even the major currencies. So this is something we do need to look at very carefully and to look at the impact that this is going to have. We think it will continue to have an impact, particularly within the region, putting other regional currencies under continued pressure. So even if we see some stabilization here with regards to the renminbi, we think that will continue to have an impact elsewhere. So currencies, particularly the exporting currencies within the region, are likely to continue to feel that downward pressure, and we will continue to look at the Korean won, the Taiwanese dollar, even the Singapore dollar as indicators of that amount of pressure which is continuing to feed through. If those currencies continue to come under pressure, we would take that as a broader signal that this is going to have a continued broader effect throughout the region. And even when we look towards the G10 currencies, there we're seeing it having an impact as well. The currencies which are heavily exposed into China, such as the commodity-related currencies of Australia and New Zealand, are likely the most exposed in our view. We think those will continue to come under some further pressure as well. But I think the currency which has had the most interesting reaction is the euro. The euro is actually providing, or is in fact gaining, some support on the back of these developments. And the reason for that is that the euro has very much changed its status and its role within global currency markets since the introduction of the more aggressive ECB policy at the beginning of the year with negative rates plus QE. That has turned the euro into a funding currency. So when we get a global shock, such as the Chinese announcement, that has the impact of reducing global risk appetite, and currencies which have been used for funding purposes, which has been the case for the euro since the beginning of the year, will actually allow the euro to gain some support as it reduces those outflows, and may actually see some inflows on the back of position unwinding. And we know that there's also an underlying structural inflow into Europe as well. So that suggests the euro is going to continue to gain some support. So you could actually see now the euro starting to outperform some of the other Asia regional currencies. So where we traditionally look at Asia against the dollar, we think we're in a position now whereby we could see actually the euro outperforming many of the regional currencies, so such as the Korean won, as we mentioned before, and the Singapore dollar.
Ian, hi, good afternoon. So what about some of the emerging market currencies like India? Do you think there's a risk of revisiting the currency crisis of 2013, or would it be too early to panic on something like this?
Yes, I think with regards to India, and we think there again it's going to come under some further pressure as a result of these developments. And again, it's an interesting situation whereby the fundamental picture has been one which the market has looked at quite positively recently, and that has allowed the currency, the Indian currency, to gain some support on the back of the inflows, on the back of those positive domestic developments. But when we get an international shock such as the announcement from China, then that can lead to some position unwinding, as we were just discussing, and currencies which have enjoyed some of that support then start to become quite vulnerable. So currencies where there's a positive underlying domestic picture could initially come under just as much pressure as maybe some of the countries or currencies where the fundamentals are not quite as strong, because of those previous inflows had provided some support. So as they are reversed as a result of the deterioration in the global picture, then that could leave currencies exposed, and I would put India into that category. So we think there is still some pressure there, but we probably would not be comparing it, obviously, to the previous 2013 example.
Okay, fair enough. It is this uncertainty that is causing a lot of heartache to China's trading partners, because first we thought it was just a one-day measure. Now it's come to the second day of devaluation. Do you reckon that this could be an overhaul of the forex regime and a currency war perhaps from the Chinese government, or is it going to stop at just these 2 days of devaluation?
Yes, the changes which have been introduced within China that does actually mean that the currency is going to be allowed a far more flexibility to move with underlying market developments. So that was one of the objectives for these changes. So that does potentially mean that we could see some more volatility and more flexibility as a result of these changes. And it does look as if now the Chinese authorities will be looking at the renminbi, not just against the dollar, but more on a trade-weighted basis. So that's quite an important change. So it does mean that the market will have to change the way in which it looks at the renminbi. But given these changes, it does mean more flexibility, which does mean more volatility.
Okay, and thanks a lot for your time today. That's the view from Morgan Stanley. The market